back. It's time for another deep dive. And today, we're going to be tackling something that's, well, a little bit dry, but super important.
hmm
We're talking about the world of GAAP and non-GAAP. You know those terms you see thrown around on financial statements, and
Yeah.
maybe you've skimmed over them, or maybe you've just felt totally lost. But trust me, by the end of this deep dive, you'll be able to decode these reporting styles and use that knowledge to make smarter investment decisions because let's face it, companies can get pretty creative with those non-GAAP numbers. So we're going to give you the x-ray vision you need to see what's really going on.
Absolutely. We're going to peel back those layers and empower you to analyze companies like a pro.
All right, so let's kick things off with the basics. What exactly is GAAP and why should we even care?
Well, GAAP stands for Generally Accepted Accounting Principles, and it's essentially the rule book for financial reporting in the U.S.
Ah, the rule book. Okay, so like the official recipe that makes sure every financial cake is baked the same way.
Exactly. It ensures that companies are reporting their financials in a standardized and consistent manner.
Okay, so that makes it easier to compare different companies apples to apples.
Precisely. Without GAAP, it would be like trying to compare a gourmet meal to a fast food burger. You wouldn't know what you're really getting.
Right. And that consistency and transparency are crucial for building trust in the market.
Absolutely. Investors need to know that they can rely on the numbers they're seeing.
So GAAP is all about providing that solid foundation of trust. Okay, got it. But then we have this whole other thing called non-GAAP, which seems like where things can get a little more, well, interesting.
Yes, non-GAAP metrics give companies some flexibility to present their financials in a way that they believe better reflects their underlying performance.
So it's like they're adding their own special sauce to that GAAP recipe.
That's a good analogy. Now, don't get me wrong. Non-GAAP metrics could be very useful for understanding a company's true earning power.
Okay.
But it's important to remember that they're not subject to the same rigorous standards as GAAP.
So we need to be a little more careful with those non-GAAP numbers.
Exactly. We need to scrutinize those adjustments and understand what's being excluded and why.
So what are some common adjustments we might see?
Well, one frequent adjustment is removing the impact of one-time events.
One-time events. Okay, so like if a company sells a huge building or something.
Exactly. That gain might not be reflective of their typical business operations, so they might exclude it from their non-GAAP earnings to show a clearer picture of their recurring profitability.
Makes sense. It's like saying, hey, this big windfall is great, but it doesn't really tell you how we're doing day to day.
Right. Another common adjustment is excluding non-cash expenses like depreciation or amortization.
Non-cash expenses, I remember struggling with those in accounting class.
Because these are expenses that reflect the gradual decline in value of an asset over time, but they don't involve an actual outflow of cash.
Okay, so depreciation is like saying your car loses value every year, but you didn't actually spend any money on that loss today.
Precisely. And companies might argue that excluding these non-cash expenses provides a better picture of their cash flow.
I see. So it's about showing a different perspective on their performance. But how can we tell if these adjustments are legitimate or if they're being used to, well, kind of fudge the numbers a bit?
That's the million-dollar question, and it's where critical thinking comes in. We need to scrutinize those adjustments and ask ourselves, are they consistently excluding items that are actually recurring?
Right, good point.
Are they emphasizing flattering metrics while downplaying less favorable ones? It's all about understanding their motivations.
This reminds me of how companies like Amazon and Microsoft often use non-GAAP metrics to highlight specific parts of their business.
Yes, they do.
Like Amazon often excludes gains or losses from their investments.
Right, which helps investors focus on the performance of their core e-commerce and cloud businesses.
And Microsoft often reports revenue growth on a constant currency basis.
Exactly, to remove the impact of those pesky currency fluctuations.
So they're essentially saying, hey, this is how we would have performed if the exchange rates hadn't been so crazy.
Precisely. But it's still important to look at both the GAAP and non-GAAP numbers.
Gotcha. GAAP gives us that reliable, standardized view, while non-GAAP can offer additional context and insights into what management wants to emphasize.
Exactly.
It's like seeing both the raw ingredients and the chef's beautifully plated dish.
I like that analogy.
So we need to be aware of both to get the full picture.
Absolutely.
Okay, this is already making a lot more sense. I'm starting to see how understanding these different reporting styles can really give us an edge as investors.
It's all about empowering yourself with the knowledge to make informed decisions.
Now I'm curious to dive deeper into those red flags and see how we can spot potential manipulation.
Let's do it. We're going to equip you with the tools you need to become a financial detective.
I'm ready to put on my Sherlock Holmes hat. Let's crack this case.
All right, let's go.
All right, so we need to look at both GAAP and non-GAAP numbers, but with a critical eye on those non-GAAP judgments. Are there any, like, red flags we can watch out for?
Oh, absolutely. One of the biggest red flags is when companies consistently exclude the same non-recurring items year after year.
So it's not really a one-time thing if it keeps happening.
Exactly. If it's happening that often, It's probably not as exceptional as they're making it out to be.
Makes you wonder what they're trying to hide.
Right, and another red flag is when a company's non-GAAP earnings consistently and significantly exceed their GAAP earnings. It could be a sign that they're trying to downplay some underlying weaknesses.
So a big gap between GAAP and non-GAAP earnings is definitely something to pay attention to.
Yes, and pay attention to how transparent they are about those adjustments.
Mm-hmm.
If the explanations are vague or if they change their methodology frequently, that's another warning sign.
It's like they're trying to pull a fast one.
Right. Now let's talk about a specific non-GAAP measure that often comes up, adjusted EBITDA.
Oh yeah, I've heard that one thrown around a lot. What exactly is that, and why do companies use it?
Well, EBITDA stands for earnings before interest, taxes, depreciation, and amortization.
Got it.
It's a measure of a company's operating profitability that strips out certain costs to give you a sense of their core earnings power.
So it's like looking at their profits without the distractions of debt financing taxes or the accounting treatment of their assets.
Exactly. And adjusted EBITDA takes it a step further by adding or subtracting other items that management believes are relevant.
Okay, but doesn't that give them a lot of leeway to manipulate the numbers?
It's true, there is potential for manipulation. That's why it's crucial to understand what adjustments they're making and why.
For example, I've heard some companies add back stock-based compensation. Is that a legitimate adjustment?
Well, stock-based compensation is the cost of granting stock options or shares to employees. And some companies argue that it's a non-cash expense.
But it's still a real cost, right?
Exactly. It dilutes the ownership of existing shareholders. So it's important to be critical when evaluating these adjustments.
So how can we tell if a company's adjusted EBITDA is reliable?
One way is to look for consistency in their adjustments. If they're constantly changing the rules of the game, that's a red flag.
Makes sense.
Another key is to compare their adjusted EBITDA to their industry peers. Are they using similar adjustments or are they an outlier?
Right, so we need to see if they're in line with the industry norms.
Exactly. Now let's shift gears and talk about something even more fundamental, cash flow.
Oh yes, cash flow, the lifeblood of any business.
Precisely. No matter how impressive a company's earnings might look, it's all for naught if they're not generating enough cash to run their business.
I remember learning that early on in my investing journey, cash is king.
Absolutely. And the cash flow statement provides a comprehensive view of the actual cash coming in and going out of the company.
So it's like looking at their bank account activity.
Exactly. It's a much more concrete and revealing picture than just looking at earnings.
So the cash flow statement breaks down their cash flow into different categories, right?
Yes, it breaks it down into three main categories: cash flow from operations, cash flow from investing, and cash flow from financing.
Okay, could you break those down for us?
Sure, cash flow from operations shows how much cash the company generated from its core business activities.
Okay, so it's the cash they're making from actually selling their products or services.
Right. Cash flow from investing shows how much cash they're spending on investments for future growth, like buying equipment or acquiring other companies.
So it's about how much they're putting back into the business.
And cash flow from financing shows how they're raising capital or repaying debt.
Gotcha. So it's all about how they're managing their financial obligations.
Precisely. And by looking at all three categories together, we can get a holistic view of the company's cash position.
I see. So even if a company is reporting strong earnings, we still need to check their cash flow statement to make sure those earnings are translating into actual cash.
Absolutely. Strong earnings don't mean much if the company's burning through cash.
It's like having a fancy sports car, but no gas in the tank.
Right? You can have all the horsepower in the world, but if you can't fuel it, you're not going anywhere.
This is a great analogy. So even if a company is growing rapidly and reporting impressive non-GAAP earnings, if their cash flow from operations is weak or negative, that's a major warning sign.
Yes, it could be a sign that their earnings are inflated or that they're struggling to select cash from customers.
Gotcha. So cash flow is king. It's the ultimate measure of a company's financial health.
Exactly. And even beyond spotting red flags, understanding a company's adjustments can actually give you valuable insights into their strategy.
Oh, that's interesting. So it's not just about avoiding pitfalls, but also about uncovering clues to their decision-making process.
Right. By looking at which expenses they choose to exclude or include in their non-GAAP metrics, you can get a sense of their priorities and how they define success.
It's like reading between the lines of their financial statements.
Exactly.
For example, if a company consistently excludes certain expenses related to acquisitions, it might suggest that they're focused on growth through acquisitions.
Right. Or if they adjust for restructuring charges, it could mean that they're trying to streamline their operations.
So these adjustments can tell us a lot about the company's narrative and their plans for the future.
Precisely. And that's where the true power of understanding GAAP and non-GAAP lies. It's not just about crunching numbers. It's about using those numbers to gain a deeper understanding of the companies you're investing in.
This has been so insightful. I mean, who knew that looking at financial statements could be like a detective story?
Right, it's all about uncovering the clues and understanding the bigger picture.
Exactly. So before you wrap up, I want to make sure our listeners walk away with the key takeaways. What are the most important things to remember when navigating this GAAP versus non-GAAP world?
Well, first and foremost, GAAP is your anchor. It's that standardized foundation we talked about that ensures consistency and comparability across different companies.
So GAAP is like our North Star. It gives us that reliable baseline.
Exactly. And non-GAAP can be valuable for sure, but it requires a more critical eye. Think of it like a spice rack. Used correctly, it can enhance the flavor, but too much could be overwhelming.
Ooh, I like that analogy. We need to savor the non-GAAP metrics carefully, understand that they're meant to highlight certain things, but not replace the full picture we get from GAAP.
Right. And when you're looking at those non-GAAP numbers, always start by understanding the adjustments, what's being excluded and why. Don't be afraid to ask questions and dig deeper if something seems off.
So we need to be curious and investigate what's driving those numbers.
Exactly. And remember those red flags we talked about. Like if a company constantly excludes the same items, or if their non-GAAP earnings are way higher than their GAAP earnings, that's a sign to take a closer look.
Got it. Time to put on those detective hats.
And don't forget to compare the company's non-GAAP metrics to their industry peers. Are they playing by the same rules, or are they trying to bend the game?
Right. Context is key. If everyone else in the industry is making similar adjustments, it might be standard practice. But if a company is doing something totally different, that's a red flag.
And consistency is crucial too. If a company keeps changing how they calculate things, it makes it hard to track their performance over time.
It's like trying to hit a moving target.
Okay, so let's put this all together. Imagine you're looking at two companies. Company A has strong GAAP earnings and more modest non-GAAP earnings, while Company B has amazing non-GAAP earnings that are way higher than their GAAP numbers. Which one would you be more interested in?
Hmm. That's a tough one. I think I'd be a little wary of Company B. Those super high non-GAAP earnings could be a sign that they're trying to hide something.
Right. It's important to understand what's driving that difference.
Whereas Company A, with those more modest non-GAAP earnings that are in line with their strong GAAP earnings, might be a safer bet.
It suggests they're not trying to play games with the numbers.
So the bottom line is, we need to look beyond those flashy headlines and really understand what's going on.
Exactly. Don't get fooled by those eye-popping non-GAAP numbers without digging into the details.
Knowledge is power, right?
Absolutely. And by understanding GAAP and non-GAAP, you're giving yourself a huge advantage as an investor.
It's like having that X-ray vision to see through the smoke and mirrors.
Exactly.
Well, folks, we've reached the end of our deep dive into the world of GAAP and non-GAAP. I hope you found it helpful and that you're feeling more confident about tackling those financial statements.
And remember, if you ever have any questions or aha moments about financial reporting, you can always find us on social media. We love hearing from our listeners.
Until next time, happy investing.